Hey everyone, let's just dive right into this. Today, we're building something incredibly powerful together, a reliable, completely hype-free toolkit for picking stocks. If you've ever felt totally overwhelmed by the flashing red and green numbers, the complex charts, or all that endless financial jargon, you are in the exact right place. In this explainer, we're going to cut right through the noise. We're breaking down the exact strategies used to pick great stocks, and we're doing it by focusing on solid, long-term fundamentals. So get ready, because we are about to completely demystify the stock market.
Look, we need a quick reality check before we start. There is no magic crystal ball that tells you exactly when to buy a stock right before it rockets to the moon and makes you an overnight millionaire. If someone is promising you that, they're probably just trying to sell you some heavily overpriced online course for $997. This perfectly captures a huge problem in the investing world today. What we're focusing on here isn't a get-rich-quick scheme. It's about tilting the odds in your favor by understanding exactly why a stock's price actually moves over time.
So here is our roadmap for this explainer. 1. The stock market crystal ball. 2. Index funds versus individual stocks. 3. Quantitative analysis, the numbers. 4. Qualitative analysis, the qualities. And 5. The dollar-cost averaging strategy. Let's get into it.
Section 1. The stock market crystal ball.
Before we can even think about picking individual winners, we have to understand the two totally different philosophies people use to navigate the market. Usually, investors fall somewhere on a scale between technical and fundamental analysis. Technical analysis, well, that's what you usually see in the movies. It's the short-term day traders laser-focused on reading those massive complex charts, plotting daily highs and lows, and trying to predict super short-term price action. But for our toolkit today, we are focusing entirely on fundamental analysis. We're playing the long game. We want to understand a company's actual financial health, their leadership, their brand recognition, because ultimately, that is where the real indicators of long-term success actually live.
Moving right along to Section 2, Index funds versus individual stocks.
Before we get into picking single companies, we really need to establish a baseline of safety. The bucket analogy is just a great way to think about this. Imagine an individual stock is a single bucket, and your money is the water you pour into it. If that company goes bankrupt, your bucket breaks, and literally all your water goes down the drain. An index fund, on the other hand, is like pouring that exact same amount of water into 500 different little cups. Say, the top 500 companies in the US tracked by the S&P 500. If one cup breaks, you hardly lose any water at all, and the other 499 cups are likely growing to make up for it. The truth is, the vast majority of professional traders actually fail to beat a simple, low-cost index fund over the long haul. So index funds should absolutely be your baseline of safety.
Which brings us to Section 3, Quantitative analysis, the numbers.
So, what if you have your safe index funds all set up, but you still want to pick a few individual stocks? Well, evaluating a company's financials is honestly a lot like going on a first date. On a first date, everybody puts their best foot forward, right? They seem great. But it isn't until you start really digging into the details that you notice their actual flaws. Like, I don't know, maybe they chew with their mouth open. Wouldn't it be amazing if you got a comprehensive, totally unbiased list of a person's flaws before you committed to dating them? Well, in the stock market, you actually get exactly that. Companies are legally required to provide you with their financial statements, which lay out all their flaws and habits right there for you to see.
The first list of habits we check is the balance sheet. Now, it looks complicated, but it's really just balancing two simple things: assets and liabilities. Assets are simply what the company owns. That includes current assets, like cash they can access within 12 months, long-term assets, like a massive physical headquarters, and even non-tangible assets, like the incredible brand trust of a company like Coca-Cola. Liabilities? That's what the company owes, and what we're really zeroing in on here are current liabilities, the debt they absolutely have to pay back within the next 12 months.
And this leads us straight to our first golden rule. To figure out if a company is high risk, you simply divide their total current assets by their total current liabilities. You want this number to be greater than 1. For example, if you run this math on a powerhouse like Apple, they usually sit comfortably at about 1.4. That means they can pay off all of their short-term debt nearly 1.5 times over. It's a massive green light for investors.
Okay, let's move on to our second document, the income statement. You've probably heard people talking about a company's top line and bottom line. Let's use a simple smoothie shop to explain this. The top line is your total revenue, every single dollar that comes in from smoothie sales. But you know, they can't make smoothies without buying fruit, right? That's the cost of revenue. It's completely unavoidable. Then you've got operating expenses, which are the controllable costs, like how many employees you hire and what you pay them. When you take the total revenue and subtract the fruit and the wages, you're left with your operating income. This is the bottom line. It's the actual profit left over at the end of the day.
And just like with the balance sheet, we have a quick cheat code to check the health of that income statement. You just take the operating income, divide it by the total revenue, and multiply by 100. Ideally, we're looking for a margin above 15%. Going back to Apple as our gold standard, their operating margin usually sits all the way up around 27%. Pretty incredible.
The final of our big three documents is the statement of cash flow. It really boils down to one super simple concept. We want to see a year-on-year increase in free cash flow. That's the cash the business can actually use to reinvest in itself or pay back to its investors. But listen, watch out for the ultimate red flag here. A company that has negative cash flow, meaning they're literally losing money, but they are still paying out dividends to their investors just to keep them happy. That is totally unsustainable, and eventually that business is just going to run out of cash entirely.
All right, Section 4, Qualitative Analysis, the qualities. Once a company passes our strict numbers test, we have to look at the intangibles. The numbers tell you exactly where a company has been, but these 4 pillars, they tell you where a company is going. We need to evaluate their brand recognition, how they're affected by the news and social media, the strength of their leadership, and whether they are positioning themselves in emerging future industries. Let's break these down.
Let's talk about the news and social media hype for a second. You probably remember the whole GameStop frenzy, right? Where retail investors drove the stock price up an absolutely staggering 8,000% over 6 months. It was a massive mainstream news story. But here is the oldest market wisdom in the book. Buy the rumor, sell the news. By the time you hear about a stock exploding on the nightly news and you decide to finally jump on the bandwagon, the smart money is already left. The big profits are gone.
And this vividly illustrates exactly why chasing hype is just a terrible long-term strategy. Take the 1990s dot-com boom. Investors were pouring literal billions into any company that simply had a .com domain name, completely ignoring their financials. The hype was deafening, but right before the bubble burst, the savvy investors pulled their profits out and dumped them into tangible assets like real estate. When the crash hit, millions were wiped out. Investors lost up to 90% of their money. Only a tiny handful of fundamentally solid companies, like Amazon, actually managed to survive. Hype creates unsustainable pricing, period.
Next up is leadership, and honestly, this is a massive double-edged sword. Take a company like Tesla, which is heavily tied to the visionary status of Elon Musk. On one hand, having a highly visible, groundbreaking leader is one of the company's absolute greatest strengths. It drives immense consumer interest. But on the flip side, it's a huge vulnerability. The company's stock price becomes hypersensitive to that single leader's actions, and sometimes even just their random posts on social media. As an investor, you have to weigh that reliance very, very carefully. The final qualitative factor is keeping an eye out for shifting sectors. Historically, we went from having coal delivered in heavy sacks just to heat our homes to the widespread adoption of gas heating, and now we are rapidly transitioning to renewable electricity and EVs. As a long-term investor, if you get stuck in your ways and ignore these massive generational shifts, your portfolio just gets left in the past, exactly like the coal industry. You always need to be asking yourself, is this company leading the charge into the future, or are they desperately clinging to the past? Finally, Section 5, Dollar Cost Averaging Strategy.
Okay, so you've crunched the numbers, you've evaluated all the intangibles, and you've found a fantastic company. This leads to the absolute most common beginner question out there. How do you predict the absolute best time to buy a stock? Like, when is it at its very lowest? Well, the answer is, you don't. Literally nobody knows how low a price will go or when it'll bounce back.
So instead of trying to guess perfectly, we use a neat strategy called dollar cost averaging. Imagine you find a stock you love, and instead of throwing all your savings at it on day 1, you just invest a set amount once a month for 3 months. Say in month 1, the stock costs $200. In month 2, the market takes a dip and it's $150. In month 3, it dips even further to $130. Because you spread your money out and continue to buy the dip instead of freaking out and panicking, look at what happens. Your average buying price actually drops to $160. Most people totally panic when the market drops, but if you've done your fundamental research and you know for a fact the company is solid, a market drop is basically a giant garage sale. You're getting a great company at a bargain price, significantly lowering your overall cost.
We have covered a ton of ground in this explainer today, from reading a balance sheet to ignoring social media hype. But I want to leave you with this one absolutely crucial question to ask yourself right now. If the market shifts tomorrow, does your portfolio have the fundamental strength to weather the storm?
Or is it just running on hype? Use this toolkit, start looking past those flashy first impressions, and take real control of your financial future. Thanks so much for joining me, and I'll see you next time.